House hunters often spend weeks, months, and sometimes even years searching for that perfect place to call home. Finally, they find it. Great space, perfect location, priced within budget. However, before signing on the dotted line, buyers of co-ops and condos should do their homework, or, as it is referred to in the legal world, their due diligence. I would like to welcome my listeners in the United States and all around the world. I am Vince Rocco, and this is Talking New York Real Estate. At this hour, when purchasing a co-op or condo, a buyer with his or her legal counsel, banker, and real estate agent should undertake due diligence together, review their findings, and determine if the purchase makes sense. Legal advisors have varying options, or opinions rather, on how much activity should be included in the due diligence process, and often the process is shaped by the details of a particular sale or its market conditions. We will have all that and so much more as Talking New York Real Estate gets underway on this Tuesday morning. In the news this morning, WeWork, the real estate company that offered startups and individuals sleek quarters to pursue their entrepreneurial dreams, filed for bankruptcy protection last week after years of struggling to find its footing. The company filed for Chapter 11 bankruptcy protection in New Jersey as part of what it described as a comprehensive reorganization of its business. The company said creditors holding 92% of its secured debt had agreed on a restructuring plan that would include reducing its portfolio of office leases. And our chief economist, Greg Heim, here at Brown Harris Stevens, reports today mortgage rates fell after 7 straight weekly increases, with demand for adjustable rate mortgages on the rise. A Missouri jury found the National Association of Realtors and several brokers conspired to artificially inflate commissions in order to pay $1.78 billion in damages. Shortly after that verdict, a national class action suit was filed, and NAR CEO announced he would resign earlier than had been expected. There is also now a similar lawsuit that just occurred here in New York City, and we will have more on that as it comes in. Greg also says job growth in October was less than expected. There were 150,000 jobs added last month, 20,000 below the Dow Jones forecast. And in economic news, stocks rose sharply after the jobs report had posted their best week of 2023. The services sector slowed for a second straight month in October as U.S. manufacturing activity contracted sharply last month. President Biden also has signed the first executive order on safe, secure, and trustworthy artificial intelligence, with the average asking rents in doorman buildings now dipping 5% from September to $5,969, while non-doorman buildings dropped 7% to $4,066. Compared to last month, one-bedrooms and non-doorman buildings were the only category to post an increase in average asking rent. The number of signed contracts fell 26% last week and was 18% lower than a year ago. Resale contracts, though, were 32% below the prior week, while new developments rose 62%. All market areas had fewer signed contracts than the week before, led by a 47% decline in Upper Manhattan. And finally, Barbara Walters' long-term Upper East Side apartment, last listed for $17.75 million, found buyer. Less than a year after the beloved journalist's passing, the apartment at 944 Fifth Avenue received a $2 million price cut from its original asking price of $19.75 million in April. Barbara Walters lived in the 5-bedroom, 5-bath pre-war apartment for 30 years until her death in December at the age of 93. Okay, with me today are John Hudak from Official, Jessica Silva from Brown Harris Stevens, Bruce Cohen from Cohen and Frankel, and David Rodriguez from Loan Depot. David, I want to start with you. I mean, this whole due diligence conversation that we're going to have this afternoon, it starts with the bank, it starts with the agents, it starts with the attorneys. When I'm teaching this in continuing ed, and I say these things, agents in the audience look at me like, well, I don't really have much to do with due diligence. It's all about the attorney. It's all about the banker. And my hair stands up taller than it already does. And I say, excuse me, we all are in this. So from your perspective, we have an agreed upon purchase price. There may or may not be contingencies. What kind of concerns do you have when looking at an overall candidate and the financing of this candidate, or even in the building, before we even get down to, because I'm hoping that the pre-approval process has begun?
Perfect.
Correct?
Well, so first, thanks for having me.
My pleasure.
So when I teach mortgage, I always like to talk about 5 milestones, right? So we talk about the 5 things it takes to get an actual commitment letter are going to be your credit, your income, your assets, building approval, and appraisal. So I coach the clients, I coach the agents that we are not releasing that commitment letter until I have all 5 things cleared. And also, that's what the boards want to see, right? So I
Good point.
So I can do a lot of this up front. I do the credit, income, and assets while we're pre-approving. I get documents, things like that. I can coach a client on the appraisal. So for example, if we're putting down 30% and I know the product allows up to 80%, that gives me a little bit of wiggle room for the appraisal. So right there, I've cleared credit, income, assets, appraisal, all before we're even in contract. The hardest part that we're seeing right now, and we're going to kind of dive into later on, is going to be the building approval, right? So banks, previously, if you were to ask me 5 years ago, I'd be like, oh, well, we have this amazing lender list, all the deals we've ever done. We have an approved list of condos and co-ops, and we're condo experts. And that's really all bankers did. Like, they didn't really know how to dive into the numbers of buildings. And now we're having to flip the script completely, right? There's been a lot of changes. If we go back to the crisis, after the crisis, condos were one of the highest risk in 2008. So you saw in 2012, Fannie Mae came out with all their rules and the CFPB, all these things. And so condos had to have reserves, and they had to have reserves of 10% on their budget, right? New York, remember that time? Like, New York was going crazy. And then we saw changes, and then come 2021, we saw the unfortunate collapse of the Surfside condominium in Miami, right? And so now the banks are being pressured by Fannie and Freddie. I always say that that's the gospel of our industry. And Fannie and Freddie are saying, hey, we want to make sure that not only is the building have no structure, they want to confirm that there's no structural issues. So they're going to ask if there's an engineer's report in the last 5 years. And they're also going to ask if there's any assessments, are they going towards any structural defects or anything of that nature? But more importantly, they want to see that there's enough money set aside for future issues. We're hearing, and I'm not confirming this, but some of the issues that happen with Surfside are from the pool deck, right? And so that could have been
structural issues
that should have been done ages ago and maintenance collected. And so this is what the banks are honing in on. And you're starting to see, when we look at condo approval, there's a limited process, I call it the easy pass. And then there is the full review process. And you're seeing banks, even on the limited process, which we typically on limited do not look at budget, we don't look at financials. It's so easy. There are some banks, so not mine, but some banks out there, one of the banks I used to work for, they are asking for financials. Even though they're not going to look at them, they want to look at the notes to make sure there's nothing crazy going on. So
you're talking about the building financials.
Correct. Mm-hmm. So something that I'm coaching on, again, credit, income, assets, building approval, appraisal. One of the things we start early on, and what I'm teaching the agents and what I always like to teach on a gut check. If you hear that building has an assessment, we need to dive into that. If you see a facade, that has all this scaffolding, we need to dive into that, because the bank's going to ask those questions and they're going to dive deep, right? And again, engineer's report used to never be asked for. Every questionnaire on every bank now says, in the last 5 years, has there been an engineer's report? And if yes, provide. And if any of you have ever looked at an engineer's report, it's never good, right? And so you want to make sure that you're asking those questions and also collecting all the data for if there's an assessment, what's going on with the structure. And that's where the bankers these days, this is where really the New York City condo co-op bankers are going to stand out versus the call centers, right? That was a long
but let's stay on the buildings a little bit, because we're going to get to it later, but now that you bring it up. So it's been my experience, and certainly I remember 2008 and 2009, selling brand new condos, which was my thing, it still is, but it was a disaster, okay? Brand new was a disaster, existing condos just as much. But it's been my experience that when banks say they don't want to lend in a building, it's more on the condo side than it is on the co-op side. And in my opinion, co-ops are a flipping mess, typically, right? They've got underlying mortgages. They've got huge debt. I was just talking to somebody in a co-op yesterday asking me my opinion on the financials. I'm like, you want my opinion on financials? Are you kidding me? Anyway, it was pretty basic, so I can answer his questions. But they're in a lot of debt. So why don't banks have issues there?
So everything comes down to monthly payment, right? So if we think about it, even if you have debt, think about it as a personal perspective. If you have a lot of debt, but you have a lot of income to cover that on a monthly basis, it's okay. So if you have a co-op that has an enormous amount of, a huge underlying mortgage, but their income is also huge, right, to cover that expense plus everything else, that's not a bad thing. Actually, we see some co-ops take out, especially during 2021 and 2020 when rates were so low, we saw a lot of co-ops take out underlying mortgages just to replenish reserves and prepare for future capital improvements. We're okay with that because, again, the payments, it's small. And again, banks hate assessments. Everywhere else in the country, assessment is a bad word. Except in New York, we use assessments to keep our monthly maintenance down, to keep the price high.
And you can write off a certain percentage of the assessment over what you can in a maintenance payment or certainly in a common charge payment. What are the underwriters looking for, other than what you just said, specifically from an applicant's perspective? Okay, we get past the building, then we start looking at the applicants. What are they actually looking for with that applicant?
So again, going back to the 5 things, credit, income, assets, right? Those are the core pieces of a mortgage. So number 1 on credit, if you're getting a jumbo loan, so if you're a buyer out there and you're getting a loan amount over $1,089,000, you're going to see a lot of banks want to see that you have at least 3 things open on the credit, right? So a lot of our newer generation, think about like when I went to college, there was a bank that rhymed with Schmel Schmargo, and like I wanted a hat, and they would give me a credit card and a hat, right? Everybody had credit cards like when I went to university. Now the new generation, they don't even have a credit card. They do everything by Venmo, Zelle. And so when they're trying to get these large mortgages,
there's no established credit.
There's no established credit, correct. So one thing that we're really coaching, especially if you're a rental agent and you're listening to this podcast, you are the next generation of the future buyers, right? And so when you see those credit reports, you need to be coaching your buyers or future buyers. You guys say, hey, you only have 1 thing on your credit report. It might be not a bad idea to open 1, 2, or 3 things, right? And use 1 for your Ubers, use 1 for your groceries, and use another 1 for travel. But banks are going to want to see 3 things. When it comes to the income side, this is the hardest one. My concern is going to be next year because right now, if your base is your base, we're good. A lot of people in New York receive bonuses. We do a 2-year average of the bonus as long as the income is increasing. What do we think is going to happen to bonuses next year?
Not be great.
They're not going to be great. And so now the banks are going to use the lower of the 2 years for that, right? Around the country, a lot of big concerns are coming around hourly employment. So if we look, the Fed is purposely trying to lower hourly wages, and they're purposely trying to lower amount of hours worked to lower inflation. You're going to hear me talk about that this entire podcast, lowering inflation. And so if we think about it, now banks are going to be scrutinizing the amount of hours worked if you're an hourly employee. It doesn't really happen for us in New York City, but you're going to see that around the country. They're going to be scrutinizing hours worked. And then our self-employed people, I love them, right? I do a lot of self-employed.
We are all one of those.
Don't know anything.
So half of our wonderful friends.
I don't know any of that. Exactly.
There's a lot of our friends and colleagues currently on retreats right now and getting all these write-offs, right? Well, when we look at our income, again, on a self-employed person, the banks are doing 2-year averages. And if your average went down, they're going to use the lower of the 2 years. So be careful on your expenses. We just saw a lot of people file a lot of people that are self-employed file an extension, and then they file their tax return in October. And I'm seeing those tax returns, and they took hits. And so we're going to see, this is where, again, your banker that's at a call center is reading a script. They have no idea how to address all this. And I'm going through the credit, income, asset, building approval, and appraisal process.
Our show's economist told me this morning before I came into the set here that inflation numbers reported as of this morning, which I have not seen yet, have gotten better, came down on the morning reports.
Huge. So if we think about it,
how does that affect interest rates, which I understand also have been dropping a little bit these days?
So let's talk about that. I've always, how many times I've been on here and I talk about, if you don't know anything about finance, you don't need to. The main concept here is rates went up because of inflation. Mortgage rates follow inflation. As inflation goes up, rates go up. As inflation goes down, rates should come down, right? Eventually, right? There's going to be some minor things in economic reports that will affect that. But if we look at the jobs report last week, we saw jobs came in under expectation. Rates came down, right? That was a good thing. We saw the Fed didn't raise rates. Rates stayed stable. Didn't move it a ton. But now this morning, we saw that inflation numbers came in under expectation. And the main thing here is looking at, when you look at New York Times alerts, you look at NPR alerts, and if it says anything came in over expectation or under expectation, that's when we're going to see movement. So today came in under expectation, meaning going back to our inflation concept, inflation came down, meaning rates are going to do what? They're going to come down. So that's why today we're seeing also we're going to see all the reprices here in the next few minutes, and they're going to be quite favorable. So everybody that's on the sidelines right now, we're going to see a little bit of a nice holiday rush coming through.
From your mouth to God's ears.
Fingers crossed.
Absolutely.
We could always use that kind of a holiday gift.
Mr. Bruce Cohen, great to see you again. So in your opinion, when you start the diligence process, okay, as I said, it's a 3-part thing. The agents, the banker, the attorney, okay? But you're really driving the bus from the attorney side. What is it you're looking for from the very start of the diligence process when you get that deal sheet? And I can go off on deal sheets being completely incorrect, you've heard me before, frustrating, okay? What is it you're actually looking for?
We're looking for not anything in particular until we do our due diligence, and then we see what we see. So let me explain what I mean by that. Our due diligence consists of, if we could look at the minutes, which could be sanitized, if we can, the financials are out of date, and we have a questionnaire that either we pay for or we speak to.
When you say financials out of date, they're not caught up from the year before?
Correct.
Which is
sometimes
always
2 years. Sometimes a year and a half.
I never understood that.
Yeah. And it depends on whether they report on a fiscal year. Sometimes they're just behind. So, and then we have a questionnaire.
I'm going on record saying they're just behind. Period.
And what we do is we look for, and our questionnaire is how much is in the reserve, are they doing any work, how are they paying for it, do they expect any assessments, any increases? And then new questions come on our questionnaire, like does a purchaser have any obligation to the building when they move in? Because I found out once many, many years ago, the building made my client replace the windows, and I didn't ask the question, and the client was pissed at me, and I understand why. So it's a living thing. I look for consistencies between those 3 things. I look for inconsistencies between those 3 things. And also the client, maybe they're doing work. Maybe it's a pied-à-terre. It's an interactive procedure. So we go, I ask them, and then they'll tell me if there's anything in particular they want. Now I have another issue. I always say to clients, listen, I do due diligence for a different reason than the bank does. Banks can get exceptions. For example, the 10% or the fidelity bond isn't high enough, and I'm even able to get that increase. There are these guidelines, basically, that the bank could say, you know what, we'll waive that and lend anyway. My biggest fear, even though it wouldn't be my fault, is if the bank says that they're going to give a commitment letter, they give it and then they won't lend under it. And for me, it's a nightmare because the client could lose their down payment, because everybody thinks that a mortgage contingency means the bank showing up with money. It's contingent on that. It's not.
No,
it's contingent on getting a commitment letter. Now, that's why I've spoken to David, where I say, I get him on the phone with my client, and I say, I want you to look my client in the eye over the phone, and everybody laughs, but I'm serious. Tell them under what circumstances you will give a commitment letter and you won't be able to fund. And I want to put his feet to the fire, so he says, if you lose your job, if there's a litigation against the building. Now, in a co-op, you get somewhat of a funding contingency. Now, a funding contingency is in the event the bank issues a commitment letter
That's very
and
scary.
they won't lend, will you get your money back? They'll never, it's not the market to get it back. If you lose your job, that's your problem. If you lie to the bank or even make a big mistake and tell them you make a certain amount of money a year and you don't, that's your problem. Although if you get turned down, you would get your money back. But in terms of once they issue a commitment. But other than that, I try to get something that says, in the event the bank issues a commitment and they won't fund, and it's for reasons unrelated to the purchaser, they'll give the money back.
Huge.
Now, when I speak to the client, the first thing I say is, in the event the bank didn't show up with the money, would you be able to come up with the money in order to close, or would you lose your down payment? And a big sigh of relief when they tell me I borrow from family, whatever, but I don't always know. And one of the other things that David brought up that I wanted to mention, it's not just what the underlying mortgage is at the time. Right now, rates were ridiculously low. So these commercial loans on the underlying mortgages were 4 or 5%, not 3 and 4%, but still very low.
Reasonable, very reasonable.
If the bank if that mortgage is coming due in the next 2 years, you could have a 7 or 8% mortgage, which will double the monthly payment on the underlying mortgage, which will throw all his numbers.
Well, that's
out of
the
whack.
conversation I had with this board member and shareholder in the co-op last night on the phone, because they are approaching just that. Their very low interest rate loan is coming due. They need to refinance again, probably for half of what they did the first time, and now they're looking at 7 or 8%.
That's correct.
And so now trying to get out of debt is difficult for them because now they have to double their monthly payments. So what do? Do we assess the shareholders? Do we assess the shareholders and increase the maintenance? I mean, he was talking about a 10% increase, and I thought, whoa, 10% is a showstopper for buyers coming in, doing diligence with their banker, doing diligence with the attorney. I mean, if I saw that and say 10%, so what is it going to go up to next year? 15% or even 10% again? Those are big numbers. John Hudak, let me ask you, so do you agree that when you start with a buyer, you start your due diligence process when you first meet that buyer, say for the first time, whether it's a referral or you've done work with them before, do you kind of consider due diligence beginning at that moment?
100%. I think it's a different type. I think you have to, pre-qualify a buyer towards whether it's a co-op, whether it's a condo, just to see if they're able to afford something in the city. Because we can go show and show all these properties to somebody, and if they're not qualified, that's a waste of our time. And most importantly, it's a waste of their time as well too. So it's a different type of review than obviously when you actually find a property.
Because as I tell people, I agree. I tell people all the time, listen, when we do get to the point where we put an offer in, you have to have a pre-approval from the bank. You have to have a revenue financial statement done. Because as Bruce said before, you can tell me you have all the money in the world to do X, but then if you don't, at the end of the day, that's really your problem. So we have to make sure that all these documents are in place up front, that they are qualified. Co-op buyers are very different than condo buyers. And everybody starts out wanting to buy a co-op because they're 10, 15% cheaper, typically.
Right.
However, they're not going to qualify to pass the board.
You'd be surprised how many calls I get on a Sunday or Monday of agents that have taken their clients out and they haven't gotten them pre-approved yet. And I'm like, what are you doing? You should be partnering with your bankers, right? And you should be the first person that they speak to before you go out and show is the bank, right? Because here's the thing, if you work with the right partner, the banker's going to say, hey, by the way, John, so I spoke to this client, and obviously if the client gives us access, an allowance, that was my compliance piece. What we'll do, is we'll say, hey, by the way, I talked to the client, credit looks good, 780 credit score. On the income side, they have a 25% debt to income ratio. You're good for a co-op. The post-closing reserves for a co-op are a little light, so we're going to have to get a gift from mom and dad. And then here's your parameters, $900,000 purchase price for a co-op, $1.1 million for a condo, right? And if that's what your banker should be doing. We keep talking about team. We're going to stress that, especially in this marketplace. It's not, it's going to be, every transaction I'm seeing is more complex than ever. And I love that because the people that know this business are going to get to really shine. And that's something that I can't believe how many Sunday, Monday conversations I'm having with no pre-approvals. It's crazy. Yeah.
All right, we're going to take a break. And right after the break, we're going to continue this conversation. So don't go anywhere. We'll be right back. Okay, everybody, we're back. So, Jessica, let me ask you. So, when you first start working with a buyer, again, whether it's the first time or not, how difficult is it sometimes to get the buyer to give you the information you need that is going to feed the diligence process that we all have come to know and love? Because sometimes people say, I'll wait until it's time to put an offer in, or I'll wait until it's time to do a board package to give you my financials. The Holy Grail, right? Nobody wants to give you their financials. How hard is it, and how do you accomplish getting from them what they need, you need, rather?
So that's a great question. I'm pretty tough on my buyers. I'm pretty honest with them, especially with New York City where we're heavily co-op and you have to get pre-approved. And you have to make sure that you're heading in the right directions. I actually do send out the revenue financial statement in like one of our first conversations and say to them, to your point, before we go out and start wasting our time, let's figure out that we're going in the right direction. How are you paying for this? Is there going to be a gift? Right, exactly. Is it cash, which we wish for? But I want to know all of that information.
$100,000 shows up in the bank account, a week before board submission.
Oh no, my
Where did that come
is
from?
all the money that comes in after somebody's been newly married and they get like 30 deposits in their board package, and you have to sit there and say, oh yeah, they got married. What I also do is I have the revenue spreadsheet. I have it on an Excel spreadsheet. So I send it to them, and what it does is it auto-populates onto another, so I can calculate their DTI. And it's not just their DTI, it's their DTI based on bonuses and based on base, because we know that bonuses never get the same credit that a base salary is going to get. So it's also based on post-closing, and it gives me a better idea of what direction we should be taking. And they, in the end, they can't really get pushback on that. I mean, if they don't want to work with me because I'm telling them.
What do you see when you get a DTI that's above the 28%, the 30% cutoff? And in one of my group chats last week, one of my favorite agents tells us in this group chat, I'm so concerned. We got a board interview approval, approved to be interviewed by the board, but my client's DTI is 70%. But yet they have $18 million in cash in the bank. So my first response back was, okay, so why do they have a 70% DTI when they have $18 million?
Yeah,
$11 million of it is in cash, and they're spending, I think, $3 million for the apartment. She said they just like debt. And I thought...
Okay, well, first of
Really?
all, my question to that is, it's a twofold question. Why would they even submit an offer based on a 70% DTI?
Hello?
And, if I
I'm
was
waiting for the
representing
board
the
interview.
seller, but if I was representing the seller, I would say come back to me when your DTI
How
is
did it get
lower.
that far?
Exactly.
Or
I mean, we even
restructure
had
the numbers. Like everybody.
Well,
knows
how
you're
does a banker look at that and say, wait a minute, this
because
is...
they have so much in assets.
Well,
that's why.
so we look at it several ways.
Yeah.
Either you're getting dividend and interest income on your tax
Yeah.
return, right? Or you're doing asset depletion. So you're saying, okay, over 360 months, if I depleted all these assets over a period of time, what's that payment? We have several different approaches to it, but I would go with the agent and say, hey,
Sorry, my heart just
they're
stopped.
getting dividend and interest income, or even if we do a unique structure where, of the 18 million or 11 is invested, that's 5% rate of return. Here's what their income could be in the future. Like, you have to do something for the co-op. You can't just approach it with a 70%. That's
Agreed.
just inability of manipulating the numbers in your favor.
Well,
Right?
agreed. If I was representing the seller, I would say they're going to have to pay a lot more, because I wouldn't, in my good conscience, from a professional standpoint, I could never submit something with a 70% DTI.
No.
I wouldn't.
I mean,
want to
from
do
a
that in
professional
condo.
perspective, I mean, obviously they have the money. Clearly,
Agreed,
they have
yeah.
lots of
Agreed.
money in the bank.
Sure.
But I agree with you. I would
Yeah.
not put in an application at
No.
a 70% DTI. I'd say, listen, at least pay cash for the apartment. Okay?
Agreed.
Right.
Do
You
whatever
have
do
the money to do
post-closing is
that.
fine.
Right.
When I hear they like debt, I'm like, okay.
Okay.
Bruce Cohen, question. So let's talk about the timeline for diligence. I mean, everybody wants it done tomorrow. Everybody wants it done in a week. We have the banker involved. We are involved. You guys are involved. You're waiting for managing agents to get you questionnaires, to get you, financials, whatever. Sellers say, oh, I threw all the financials away. After all, I don't keep that stuff. Really? And then when you tell them they have to go and spend $250 with the managing agent, I'm not doing that. I don't need that. What do you need that for? I don't need anything. Your buyer needs something. What's the timeline that you feel most comfortable with to get this stuff done? And we're not talking about hot markets. We're talking about just in general.
In general, I would say a lot of the brokers that I work with on a regular basis, and I tell them all, if you're showing an apartment and it looks like something's going to happen, pre-deal sheet, even if I'm not
Deal
the
sheet.
attorney, tell me the address of the building, the unit number, and the managing agent. I will request the minutes, and I will ask how much the questionnaire is and get online. So that if
You do that.
I do
Yes.
that. If 4 days from then you get an accepted deal sheet, if they don't use me, I want to help the broker who's thinking of me, and I'll let someone else take my place in the line. But the answer is, you do it as quickly as you can. It used to be a week. I get all these things that say you have to, on a Monday, you have to sign by Friday. All right, great. But we all know sometimes it's just not going to happen. But I think if the other side sees you're doing everything you can, it works. And I also will tell the other broker, or through my broker, or maybe I know them, hey, I put this request in on this day. Can you have your seller help me get the due diligence? Because at least then they know I'm doing everything I can. And sometimes the client in a hotter market has to make the business decision. I'll tell them what I have and what I don't have, and they'll decide. I always say, you got to decide whether you want a weekend to go by or not, because they say they have other offers. Is it true? I don't know.
Or if you've already worked in the building, you kind of know what that building's about because you just maybe did a deal maybe a month ago, 6 weeks ago, whatever. So your diligence may not be as thorough.
Correct.
But if you haven't done a deal there, because we all know what hot markets are, you have an open house, 25 people show up, 17 offers, writing out spreadsheets, trying to tell your seller who these people are, let them know what they have, not just on the offer number, but post-closing liquidity, on and on and on, especially if it's a co-op. And then the seller says, well, we have 4 offers and I like 4 of them. I'm sorry, 17 offers. I like 4 of them. But I'm afraid that if we don't get this diligence done quickly, we're going to lose. And oftentimes we do. Okay? And so you go to the second backup or the third, and what do? They've flown the coop already because nobody wants to be second or third. Now you're starting all over again. And what do I say all the time? Try and get another offer. Okay? Right. Not always happens. Right. It's incredible. But it is what it is. But how do we, John, explain to me when you, deal sheets, the elephant in the room, okay? Deal sheets, my biggest hot button. Why are deal sheets so screwed up? I mean, they have incorrect data. It's sloppy footwork, I'm sorry, on the agent side. Both sides can't get numbers right. What's with the deal sheet?
I think it's not universal. I think every brokerage has their own type of deal sheet that they include some numbers they don't. Some numbers it's not reviewed, so they put in the wrong financing term, wrong contingency. Then
maintenance number.
Wrong exclusions or not putting an exclusion down. And then you're renegotiating the deal because the buyer saw the chandelier and is expecting to get the chandelier.
Or fighting at the closing table over a chandelier.
Exactly.
Right?
So it's like I always have my partner review it just to make sure we don't miss anything, because that also, dovetails into timing. We tell people, 5 to 7 business days is kind of a rule of thumb to have that complete, especially in a hot market. You want to make sure that, you protect your seller or your buyer and make sure that you're staying on track of everything and really utilizing your team to communicate all aspects of the deal sheet.
Yeah, what gets me all the time is, when I'm searching for properties and I look at, whatever system I'm looking at, and I see the maintenance numbers, or I see, there may not be an assessment, but I kind of know the building has an assessment, or I know that, the maintenance numbers did go up. If you put a listing up in November and then all of a sudden it's January, did that agent call his seller and say, did you get a maintenance increase? No, never. So those numbers stay the same. And when you come to a deal, the buyer says, oh, the maintenance is $1,200 a month. Okay, that's doable. Go to find out, in diligence, when the attorney says, well, you know what, the deal sheet says $1,200 because the agent's listing system says $1,200, but the management questionnaire says it's now $1,400.
Right.
Yep.
Can I go?
My buyer says, I can't afford that. I'm out.
Dirty little secret. When we get a deal sheet, we don't trust the brokers. No offense to the brokers.
I'm glad you said that.
Because you get the information sometimes from the client, and I don't trust the client.
Correct.
So we send an email, whether we're buyer or seller, asking them to confirm flip tax assessment, common charges, whatever it is. We look at the real estate taxes ourselves. And basically, what you can do to save time, if you have a seller, ask for a copy of the last mortgage statement and ask for a copy of the stock certificate. You'll have the proper name of the apartment corporation. You'll have the exact amount at the time. You'll at least be somewhat.
Go ahead.
No, go.
So I'm going to take it another side and say, as a listing agent, I always do that. Reach out to the management company to confirm the maintenance.
Generic questionnaire, right? Which will confirm that.
Exactly. It's just basic questions that we're not getting charged for.
Right.
And that's one of the questions is this the correct maintenance? The other thing is I look at property tax bills myself. Right. Because that's the only way I just have something now where the sellers didn't even realize, and I looked up their property tax because it had already gone up and they hadn't seen their new bill yet.
And make sure there's not an abatement that's running out.
Correct. Well, there's that too. If you have an abatement, what is the abatement? How long is it? And what is it going to be? People ask that question all the time.
I love it when you ask a seller, what is your current maintenance? Because I need to put it. Oh, I don't know.
I have an automatic deduction or something.
Oh, hello. You're reading my. That's exactly what I was.
They don't care.
And I'm like, well, don't you know what that number is? It comes out of your account every month. I have no idea. Well, do me a favor. Go to your online banking. Look up that number and just tell me what that number is.
Send me a
maintenance bill. How hard is that?
So what I
I throw those away. I don't keep the maintenance bills.
I get mine emailed. I delete them.
No, not me.
Yes,
that's what they tell you.
Yeah.
I throw it away.
I actually, when I'm representing a buyer, one of the first things I will do, to your point, if it's the beginning of the year, guaranteed that maintenance is going to be wrong if it was listed
100%.
in November. Yep. And I, even with my own sellers, I always ask them for the increase because you're getting it in like January or February. But you're right about that. So when representing a buyer, it's one of the things you always have to confirm because it does matter in their monthlies.
Can I go a little DMV on you?
Yeah,
on the
go ahead.
sheet?
Go ahead.
So if we think about it,
it's my hot button. Go right ahead.
So think about the names, right? The way you put the clients' names is how it's probably going to be it's going to go on the
Contract.
Correct.
And then what are we going to do as a banker? I always ask for a deal sheet. So then I'm going to match the names to the application. So if you think about it, that's going to go on the stock and lease. So the deal sheet, it seems like such a basic thing, but everybody goes off of it. And my favorite, agents don't even put their license numbers on the deal sheet, which cracks me up because guess what? I don't have it on the contract, and then I don't want to have to go search for it at closing. When we're trying to get to closing quickly, I have to issue a closing disclosure, and on the closing disclosure, I have to list the license number of the agent. So if you want to just take 2 more seconds, add your license number, make sure the names are correct, make sure like you mentioned, the condo name or the co-op name is accurate, so that the banks can do that, the number of shares, all these things. This is really. It takes 5 extra minutes to save you hours in the future.
This is the agent's job. It's like I say this all the time when I'm teaching this course. It's like, what about your job don't you get?
So
okay,
simple.
do it up front, right? So save you hours on the back end, because when the attorney calls you and says, this is all effed up, something wrong here, and we get those calls all the time, and I just think, okay.
You know what?
Ask questions.
Certain brokers are better at it than others.
Well,
But
of course.
But I look at it as we're a team. So what I do is if the seller has a loan, whether I'm the buyer or the seller's attorney, I go on Acris, I pull the UCC. I get the name of the apartment corporation. I get the name
Right.
of the seller on the
It's
stock
all
and
right
lease.
there.
It's all right there.
It's all right there. David, let me ask you something about co-op's underlying mortgage. I mean, you guys both touched on it a little bit before, but when you see that there is a higher underlying mortgage and the interest rate may be, borderline, and that if they're going to refinance again, it probably be a higher monthly payment, does that affect you or your underwriter's decision on whether you want to lend to a purchaser or not?
Correct. So we do a pro rata share analysis, right? So we look to see kind of what the coverage is. And then we also look to see, a big question on an underlying mortgage is the underlying mortgage coming due in the next 5 years? So that's what we care about. And if it is coming due in the next 5 years, then we're going to ask the question, do you plan to refi?
And what's the percentage on that, by the way? Are most of them due in the next 5-6 years, or are they longer?
Because everybody just refied.
Right.
We're not seeing a ton of that, right?
Okay.
So it was more previous. And again, we're looking at, okay, if they are going to refi, if we think worst case scenario, we then go to their reserves, right? And so if I look and see, hey, it's $1 million in income a year, they have a $500,000 mortgage, it's going to whatever, but I see $200,000 in reserves, 20% of their annual income. I'm like, okay, we're going to offset it a little bit. Co-ops, remember, have a lower rate of default, right? So the banks actually are much happier with co-op, the banks that know how to do it, because again, to get into that co-op, your credit score had to be 760 plus. Your debt to income ratio, we say up to 30, but it probably was 28 or 25. Your post-closing reserves were 24 months. So even if they do raise maintenance, we know that the client still has plenty of room. Remember, most banks allow debt to income ratios up to the 40-ish range.
100%. That's spot right on. That's exactly correct. And again, when I see this 70%, DTI, I thought
I need to be resuscitated for that one.
John, do you think that contracts should contain funding contingencies? Now, I know hot markets are different than regular markets, different than slow markets. But funding contingencies can be an issue.
Yeah, I can see both sides of it. I think in a hot market, you don't, if you have a trophy property, you have a lot of buyers that are interested in buying it. You want to make sure that whoever your top candidate is, you have the accepted offer, is qualified to purchase it. Because if they're not, then to your point, Vince, you may have 2 or 3 people that are lined up behind, and if it takes too long, those buyers probably found something else. And then not only do you lose your first candidate, you lose the second and third, and you're back to square one.
And square one might take a while to come up with buyer number 2.
It's
100%.
built into the co-op contract, by the way. If the bank won't lend because of the building or the corporation, you get it. I expand it a little. I look at it a little different. The way I look at it is, I'll ask the client, if you don't get the mortgage, are you going to be able to come up with the money? If they can't, and there is a litigation against the building that comes up new, nobody wants to keep somebody's down payment. And I just think if you get a contingent contract, if somebody wants to take the chance and not have a contingent, fine. But if you don't, I think someone should have that type of funding contingency unrelated to the purchase. I think it's fair.
How do you feel about cash deals as an attorney looking and starting due diligence? Are you more comfortable with cash deals than you are with finance deals, and why?
1,000%. And the reason is, I look at my job even if it's not something that I did wrong, is to protect my client's down payment at all costs.
Yeah.
So when I hear it's a cash deal, I just sleep better at night.
We had one of those a year
Yes,
ago.
How
we
about a
did.
non-contingency?
What?
A non-contingency.
That's a business decision for the
Yeah.
client, and as long as they know what the risk is and they're willing to take it, and I've explained it, and the brokers explained it, then they're big boys and girls, big men and women.
How
and they
often are you seeing non-contingencies these days?
Not so much lately. Last
mean,
year,
hot
in the
markets
past
is
few
a whole
years,
thing.
exactly, where I had a buyer who went to highest and best, and it was a non-contingent
Yeah.
deal. And
Which makes it an all-cash deal.
It does make it a
Right.
cash deal. It's just the same as cash. So, representing a seller, I say those are great. You're guaranteed to close. From a buyer's perspective, I'm kind of a mother hen when it comes to my buyers. So I will try to guide them away from that as often as possible to protect their own money.
One thing I like, though, in a non-contingent deal, you could put the board package in sooner because you don't need a clean commitment letter.
Yeah.
True.
Well,
True.
right.
So something like when it comes to non-contingent, I'm seeing two markets right now, right? I'm seeing a tale of two cities. I'm seeing transactions, especially my Brooklyn transactions, where they're going over ask and they're being requested to do non-contingent. And then I'm seeing the opposite side of the market, which units aren't selling. They've been on the market for 30 plus days, and now instead of our buyers coming in and asking for 10% under ask, I'm telling them, hey, why don't you ask for sellers' concessions to help buy down your interest rate, pay for your closing costs. What a great way. If you're a W-2 employee, imagine like how much you have to save to get all those costs, and now you're kind of wrapping it into the deal. So I'm seeing two markets. So when it comes to non-contingent, again, we go back to the 5 steps of what it takes to get a mortgage: credit, income, assets, building approval, appraisal. And if we tell the client, all right, you're good on credit, income, and assets, we've done it all up front, you're putting 30% down, we're good on the appraisal, you have wiggle room, and then the building, we're going to make sure to get all the documents before you sign, right? But we as a bank can never say, hey, do the non-contingent. But I can say, here's the 5 things you need to get a mortgage. And here's the most important piece. Contingent or non-contingent, banks are going to issue several iterations of the commitment letter. I need you all to listen to this. The second we put a loan in, the bank underwriters, right now, every bank is underwriting a loan for credit, income, and assets in 5 days or less. Mm-hmm. So they're issuing a credit, income, and asset commitment letter, and it's conditional on building approval and appraisal. Now, your client, if they're not educated through this and you have not educated your client through it, they're going to try to upload that to Board Packager. And we have to tell them, do not do it. There's several iterations of the commitment. And until we've completed, that's why I do the 5 steps: credit, income, assets, building approval, appraisal. That is when I will tell you you're okay to proceed to not only give that to your attorney. Once your attorney approves it, then we're going to be allowed to put the
Can
the
I ask you a
Board Packager.
question?
Yeah.
Why is that happening so frequently? Because I've run into that quite a bit. And I do manage my buyers and say it's not a real commitment letter, because until the appraisal's done, until the bank comes out and says that they will finance the building, et cetera, like you said, why are they doing that? Because it really is causing this additional layer of
This is where
torture.
regulation backfires, right? So we think about the Equal Credit Opportunity Act, right? So the ACOA,
Yeah.
a bank has to decision a loan within 30 days. And so that's where the second they can decision it for credit, income, and assets, they're good. They've complied with the regulatory piece of it. It doesn't mean it's clear to close, right?
Agreed.
So
But-
that's the problem, and that's where in New York we have to it's every bank that you talk to, it's credit, income, and assets immediately done, and then they're going to do the rest.
Okay.
All right, we got to take a break. We'll be back right after these messages. Don't go away. My agent friends over here, let me ask you about buyer concessions, as David brought up before. Are they really happening right now? Or is it just something that, bankers say, hey, this is a good opportunity. I happen to agree. Get the seller to give you some concessions. Are they really working outside of new development, okay, in resale?
Well,
Buy down the mortgage, maybe pay some closing cost for the buyer, because right now the buyers are, not really there.
And it can't be more than 3%, by the way.
No.
Well, it can't be more-
That's
right.
not always true. It actually depends on the amount of down payment. So
Okay.
here's where I want us to focus on. Let's take a co-op and let's do the lower price points. Let's take a co-op that normally trades at $500,000, right? And we've seen in that building the last 10 years, nothing is traded for less than $500,000. What happens if our offer gets accepted at $480,000 and we're in a particular neighborhood of Queens that we're not going to discuss? What do you think happens when that goes in front of the co-op board at $480,000?
yeah, they don't want that comp.
And what's going to happen?
Yeah.
The deal's going to be declined by the board. So they're going to say, we're only going to accept this if you restructure it to $500,000 of purchase price.
Correct.
So it's something that, again, what I've been coaching a lot of our first-time home buyers on is there's a way to preserve values. Because here's the thing, we're all undercutting price. Everyone wants to come in and undercut the price. but you're screwing yourself, pardon my language, for your future refinance. You set the floor of a comp, and now everyone's going to come in behind you with that comp. So why don't you, if everything currently is trading at 500, come in at 500, but you know because of rates, it's not really worth 500, it's worth 490. So go in at 500 and ask for $10,000. So we're going to comp at 500 because of the comps. Appraisal is going to be fine, and then we're going to ask for $10,000 of closing cost concessions, right? And that's going to cover some of our closing costs, but in addition, it can cover some of our future maintenance. Most banks will allow you up to 12 months of future maintenance to be paid for at the closing. That's the regulation, or that's the guideline. So 12 months of maintenance, they don't allow it on taxes. And then furthermore, what I'm seeing in like the entry-level markets, and this is something, again, the bankers, I know we're like, you said elephant in the room was deal sheet. I told you last time, I'm the elephant in the room every single time I walk in.
Interest rates.
Yeah,
oh my
exactly.
God, what are they?
I joked to somebody yesterday. I was like, yeah, I had to start working out. They're like, what's the matter? And I was like, well, I work for a bank. Ozempic's not allowed unless you have diabetes. I'm like, I'm screwed. So I got to lower this, this figure.
David, you're too much.
but when it comes to the buyers, I'm telling them, if we're comping, I just did a really good Instagram live with one of my agents upstate. We have a unit up there, a property that's should be trading at call it $489,000. Nobody's biting, and it's in an amazing area. So we're saying, all right, you know what? The seller does not want to lower the price 10% because now they're going to have to get hit for $48,000. But they're willing to take concessions to not only permanently buy down the rate, which means for the life of the loan, we're going to lower the rate. Okay. We're also going to do a temporary buy down, which means we're going to lower the rate temporarily for just the first 2 years. The first year goes down 2%. The second year, it only goes down 1%, so it's a tier. And then they're going to pay the closing costs. They're giving a package of $34,000. And if you think about it, if I'm a W-2 employee, $34,000 to me means really like $58,000 of earnings. Okay? So now I have somebody buying a second home, $34,000 of concessions, and their payment for the first 2 years is still lower than if we were to have just lowered the price 10%. And I'm preserving their future value of their place. Because now instead of the comp showing 440, we're showing 489. And now we're not going to set a floor, and I can protect us for the future refi. Because I want to try to refi in as little as 6 to 12 to 18 months, right? So this is what I'm doing with my concessions. Sorry to go way off on a tangent, but
no.
That's smart.
I think that a lot of people are trying to do that. I haven't run into that too
I haven't
much.
either.
I
Yeah.
think it's very tricky with co-ops because co-ops are a little bit more straightforward. You could probably try to do that with condos. I do see people offering that, but I haven't seen many people jumping on that. I think it also depends on the price point. A $500,000 listing is probably not going to do that.
Speaking of co-ops, talk to me about co-op board rejections. I mean,
I've
I'm
never
hearing.
had one.
I've only had 2 in my 21-year career. 2. Yeah. However, I'm hearing lately that there's been a lot more, and people always say to me, why in like weird markets, uncertain markets, do you have so many turndowns?
Financials.
Right.
Yeah.
Are we seeing a lot of turndowns?
Yes.
I'm hearing we are.
Yeah.
I'm seeing
haven't.
more from price because of price.
Because the buildings won't accept the price
So
accepted.
what I do when I hear that, this is working as a team.
Yeah.
When I hear from the broker, well, I don't know if the buildings are going to go for it, I will call the managing agent and say, hey, do you think this is going to be an issue, or should we try to do something so the price
And half
comes
the
in
time
high?
they don't even answer you.
And they
won't.
I don't know.
They
You've
wouldn't
been
know.
doing it
They
for a long
wouldn't
time.
know.
Well,
They don't
sometimes
know.
they won't answer. They won't say yes, definitely. They'll go. That might not.
Exactly.
They'll
I
hint.
can't
They'll
prop- I
speak
can't
between the
remember.
lines.
I did
which
have
they
It
that.
do
looks
answer
good,
that.
but I'm really not sure.
Right.
Okay,
Well,
got
that's
it.
an answer.
And
I guess it is.
I did have one property manager a couple of years ago who said to me outright, he was a really nice guy. I need to find him again. He said that the board is not going to accept it at that price.
Right.
So we were able to restructure it, and the buyers got a credit at closing. That is very rare that you get that kind of transparency from a property manager or anybody.
No, I totally
But
agree.
I think that in this kind of a market, really the biggest thing is financials. It comes down to financials.
Always.
9 times out of 10. And like I said, I'm ultra conservative with my buyers. I am very protective, and I'm neurotic. In case you didn't know.
No, never.
I am. Yeah, a little bit.
Me too, sometimes. All right, listen, we have a few minutes left. I want to ask you, Bruce, about unsafe buildings that seems to be the rage out there today in the press, whatever. And then Local Law 97, which is kicking in January of 2024 and beyond. I mean, because these two issues, can sink a ship. my
Absolutely.
opinion.
I think Local Law 97, which is the energy efficiency, the fines are supposed to start in 2025. I was just on a panel with HGAR the other day about it. I was one of the presenters, and the grade isn't as important as is the building doing something now?
Yeah.
Are they planning for this? If they are, it's going to be fine. Otherwise, I would say it's going to be the new Local Law 11, but it's not, because it may be worse at first, but it's not every 5 years. But they have to be making their plans now. If they wake up in 2030, they're going to get destroyed. So one of the openings for brokers that I said on the panel is find some of those buildings where they're ignoring it, go to the sellers and say, hey, you got a small window here to sell your unit because this is going to be a time bomb. And in terms of Local Law 11, I just found out that there was, I think David knows more about it than me, but from a broker who is buying, their daughter was buying, and the bank wouldn't lend because it was marked an unsafe building, and they had to go to a different bank. And I understand it's a real issue.
Before we get to that, because I want David's opinion on that, back to the Local Law 97. So what are the fines going to be like if these buildings are not adhering
Or to
to?
bring them up.
I have
Or
the
to bring them up
numbers.
to code.
Right now, it's very small. It's like $3,400, $2,400 for a year. But they're being very flexible about it. I think they're even waiving some of them as long as you show you're doing something. However, in 2030, they may turn around and they're going to be huge numbers.
So they're giving them a grace period, essentially.
Well, they're giving them a grace
some
period.
time to
Yeah.
because it's not something that can happen overnight.
Agreed.
But I keep thinking, though, that with all of these issues, that it's going to be hard for sellers to sell.
That was my point about looking at those
Because when
buildings,
you
yes.
look at due diligence, when you guys are, trying to sell whatever, we're going to be looking at these things as if we don't have enough,
And the bank's
in our
not
way anyway.
looking at it yet. From what my understanding is, right now the banks, or as soon as the banks put this in the same department as they do the Local 11, it's
Yeah.
going to be a whole new ballgame.
David, talk to us a little bit from a bank's perspective about unsafe buildings.
Okay, so going back to the questionnaire, we're going to ask if there's been an engineer's report in the last 5 years, right? And we're probably going to not. A lot of times, the managing agents do not consider Local Law 11 reports as an engineer's report. So I will say, I turn a blind eye. I don't see much, right? If they do show us a Local Law 11 or say it's Local Law 11, or I see an assessment for Local Law 11, right, I have to dig into it. So I'm going to go on DOB now, and I'm going to take a look at that report, right? And the report says everything, sometimes too much. And it's going to have a designation, and I forgot the acronyms, but basically there's like an unsafe but okay to proceed. There's all these. I don't even know what it is, right? I have to look at it, Google it every single time. But basically, the bank's going to look at if it's unsafe, what has been done so far to rectify it. If they have started the work to, correct the unsafe situation, even if it hasn't been signed off by the city, but I can show and prove that it's been corrected, the bank's going to feel a little bit better, right? Everything here is just showing that you're proactive. And a lot of times, again, this is where your banker is key. You know how many times I've had to talk to board presidents? I've had to do a war and peace write-up on every building that comes up. I'll be honest, most buildings selling right now are funky because everyone knows that it's going to get harder and they're trying to get rid of it before it gets harder, right? So every co-op condo transaction I'm seeing right now is a mess. Now, where we're going to have a big issue is when it's litigation, like we saw, I talked about this last time, the Edge condominium in Williamsburg. It has crazy litigation, like against the developer for sprinklers, things, all sorts of stuff, right? And no bank is going to touch that because now it's on the Fannie Mae do not lend list. So it's all going to depend.
And that was one hot building when it was selling.
Yeah.
Oh,
I
yeah.
did so many
Remember that.
deals.
I know, me
And
too.
it's like trades, every eight deals every month, and now cash buyers are going in like this is going to they're going to figure this out, right? And so you're seeing a lot of cash buyers in that building, even with the current issues. A lot of investors. So what I say is when it comes to local law, we just have to make sure what are the issues, have the detrimental or structural issues been completed. And if we show that to the bank, and we get an exception on it.
Local Law 11 makes my hair stand up. It gives me hives. I can't deal with it. My building, the last time, I'm living in my building 20 years. The last time, the scaffolding was up 4 years, 4 years. And, my dog was alive at the time, Jet, And every time we would go out, and she was a female, but every time we'd go out, she wanted to sniff the post on the because male dog was lifting their leg and peeing on the post. I'm like, get away from that. I couldn't wait till it came down. In year 3 of 4 years, right, I'm in my bedroom getting dressed to go to work in the morning, and all of a sudden I hear like slippage. I'm on the corner of my building.
Oh.
And I'm like, what is that? And then all of a sudden I hear crash. All the bricks on the top of the building, I'm on the 10th floor, we go up to 16, all the bricks came crashing down. Thank God it was on top of, those, whatever they call those things. And I thought, okay, 3 years into this, and we have bricks falling off the building. What are they not doing correctly? Of course, here I am running downstairs to the super. What the F, whatever.
Yeah.
Bottom line is, 4 years later, it comes down. Now, I'm cringing because we're 4 years, 7 years, I think. And I can't even imagine, but unsafe, unbelievable.
It's a real
It's unbelievable. And that's all we have for right now. I'm going to come right back after these messages with my thoughts for the week. Don't go anywhere. My thoughts for this week. The upcoming holiday season is a time anticipated by many as it brings a sense of joy, warmth, and togetherness. It is a time when people gather with family and friends to celebrate and create lasting memories. The holiday season is marked by festive decorations, twinkling lights, and the aroma of delicious food filling the air. It is a time for giving and receiving as people exchange thoughtful gifts and show appreciation for one another. Whether you're celebrating Kwanzaa, Christmas, Hanukkah, or Diwali, or any other holiday, the season is filled with traditions and customs that bring people closer together. It is a time to reflect on the year gone by and look forward to new beginnings. The holiday season truly embodies the spirit of love, kindness, and gratitude, bringing people from different backgrounds and cultures together in a spirit of unity and joy. And these days, with so many world events and conflicts happening, it is especially poignant to pay attention and spread your love and your peace. And that is our broadcast for today. Thank you for listening. And thanks to my guests, John and Jessica and David and Bruce, for being here with me on set today. You can follow me on Facebook, on Threads, Instagram, or TikTok at Vince Rocco, or my website, thinkvince.com. In addition, if you want to email me here at Talking New York Real Estate, you can do that at talkingnyc@bhsusa.com. And one more note, my colleague and friend Greg Heim, who's our chief economist at Brown Harris Stevens, has started his own weekly podcast called Crossing the Line. You can find that show once you get your podcast. Steve Jobs said, "Your time is limited, so don't waste it living someone else's life. Don't be trapped by dogma, which is living with the results of other people's thinking." To my viewers and listeners all around the world, from all of us here at Talking New York Real Estate, thank you so much for spending a part of your day with us. I will see you next time. Goodbye, everybody.